So reverse Goldilocks is no more. That was your January call, a 2017 style scenario for markets. How much of a further melt up can we have? Because you would say we're not even really overly exuberant in US equities thus far.
Yeah, good morning, Manus. I think we can go quite an awful lot still from here. Quite simply, when we look, for example, at 2017 and compare that with where we are right now, I think one thing is quite similar. It's sentiment and positioning. So on our measures, when you look, for example, at the sort of the aggregate sentiment among the largest real money asset managers, sure, it's no longer as bearish as it was 6 to 12 months ago. That was one of the key reasons why we were so bullish on risk assets overall last year. But what we're seeing currently is that people are basically sort of neutral everything. They're ever so slightly overweight in equities, but really neutral in credit, neutral in investment grade and high yield, even neutral in duration. So no real conviction there, right? So to us, I think that is one of the big similarities to 2017, where the macro environment also looked pretty healthy, pretty strong. People were talking the bullish talk, but they weren't really walking the walk, right? They were kind of stuck in saying, well, I am pretty bullish. I am talking bullish, but I can't really buy an S&P at an all-time high. I can't buy IG credit at 80, 90 basis points. I can't buy high yield below 300. So I'm going to wait for the dip. And when the dip comes, then I'll buy it. And I think what's similar now is that everyone is sort of really waiting and desperately waiting for that dip. So to us, other than a couple of percent perhaps lower in equities and a handful of basis points up in credit, I don't think there's going to be more substantial of a drop than that. And to us, that means every kind of really little drop that there is in risk assets, you're going to have to jump in very quickly.